we're looking for reasons to be bullish. And I think this entire year I've been cautiously bullish and cautiously optimistic. And my game this year has been about maintaining as much free capital and margin as possible.
We got some good stuff to chat about. But how's the market been treating everybody? What are you guys feeling? We got a couple of minutes to just talk about what everybody's been seeing. Does anyone have any insight as to where it all heads for the second half of 2022? What do you guys think?
Take it, Dave. What do you think? I'm curious. Jared and I talk every day, so I want to see what your let's get some input from you.
Well, it's not really kind of what I think, because I think that's where a lot of people go off the rails. They let their opinions and maybe too much thinking get in the way of what the markets are telling us to do. But, based on the data and based on what we've been seeing in the market, I think yesterday's CPI print kind of put the bow on stronger equities into the remainder of the year. Some quant data that I would share with you is as follows. When we see the CPI dip by 50 basis points after we've had such an extraordinary run, historically that means the S&Ps are up about 16% 12 months after. Now that's one data point that you could say, okay, well, that's taken from historical data. Maybe it won't work this time, and maybe it won't. But I think you and I, or all three of us probably, have seen in the last few weeks, every single dip in the S&Ps has been bought. Market's pretty firm. Doesn't mean we won't have some volatility and some contractions, but I'm pretty bullish going into the end of the year. And obviously that has implications on related asset classes, which we'll probably talk about tonight.
Yeah, I think that's a pretty fair assessment. Chris and I have had some interesting conversations, and there's actually quite a bit of good statistics to back this up. But Chris, we've talked about, when there's a bad first half of the year, there's a very consistent finish of that year. Which any comments on that?
Yeah, typically we can look back to I believe 2022 was the second or third worst half start of any time since 1928 in the S&P. So of every start that's been bad, they finished not at those lows. So unless we're going to go into the worst possible end at December 31st, we're going to finish somewhere probably off those lows. But the question I think that everyone is wondering now, especially with that CPI print that Dave referenced, is will we see June's low as the low? And I think Jared and I agree. And Dave, I really appreciate your point, just because, we're looking for reasons to be bullish. And I think this entire year I've been cautiously bullish and cautiously optimistic. And my game this year has been about maintaining as much free capital and margin as possible, because I think that I want to have the courage to invest. I want to have the courage to buy, but I don't want to get over confident in a deleveraged market, because we quickly saw, deleveraging since, really tech was as early as February of last year into March, into July, into November. We saw various stocks dropping at the same time. A lot of it was in tech. And then we got into this year. We had such a strong Q1 in energy, and then April, everything was down. June, everything was down. But what's interesting is the combination of, tops in the 2-year funds rate, and right now we're looking at the kind of the peak in the CPI. If we're seeing peaks in the funds rate and peaks in the CPI prints, we tend to see bottoms in equities. And one thing that I noticed a couple months ago is looking back at these Fed rate hike cycles historically for the last 50 years. The average rate hike cycle has still allowed the S&P to finish 6.9 to 60% from those rate hike starts. So if we go to if we pinpoint like a vertical line, March of this year, when the Fed first had their tightening cycle and they officially hit the prints with that first rate hike, 12 months from there, they should be around 7% off that level, and 7% higher. Again, historical average. And then after that, it's closer to 17, 18%. So, again, history as a guide shows that the market is very resilient. And I think that one thing that, traders might not be ready for, investors may not be positioned for, is that potential you missed it. If you didn't have the courage to buy into this correction or buy into this deleveraging, as the Fed is waiting for inflation to be transitory, and the narrative that, honestly, I don't know about you guys, but the Fed has driven me crazy, because I've never seen so much emphasis on what they're doing and what they're reacting to, because that's what the market wants to know. It's like, what is the Fed going to do in order for the bigger money, I think, to get positioned? So I think that's the macro stuff, but we're here to trade. And I know that Jared, you have a challenge for us. Dave, you've been on the battles before, so we know how this works. We here.
We got stuff to do. I think it's safe to say. What the Fed, right? And
what the Fed. Right.
What the Fed. And I think so. So before we get on to our first challenge, Dave, I'm curious. Just a quick thought here. Markets are down. Things are starting to recover a little bit. How do we get people to stop buying highs and selling lows? Everything's down. People want to get out of everything. Everything's up. Everyone has a lot of confidence. How do we manage that?
Wow, that is like the hardest question to give an answer to, because human nature, unlike in our personal lives, we love to buy things when they're on sale at Best Buy or at the grocery store or car dealers. We don't seem to be interested in buying things on sale in the stock market. It's a human condition. I don't know why that is. I know people are probably wanting to chase this rally, and I think sounds like we're all in agreement that we probably put in a durable low at 38.60 or 38.50, sorry, 36.50 back in June. If you missed most of the move up here, I think you've got to be patient and wait for some pullbacks, or just simply start to scale in. But I don't have an answer to your question. I don't know why people chase momentum. It usually doesn't work so well.
Jared, is it the psychology of we see, I know you and I did a webinar together. We saw like there were 3 or 4 phases of optimism and like 8 phases of pessimism. So I think the reason that people panic is because there's so much more emotion that goes into the fear mongering and the I just think that's what they're driven emotionally to just give in. And I mean, Dave, I know that you have a copy service and manage some capital. It's been some interesting conversations this year to see the same type of thing with traders, investors that have been through many years of trading and seeing look, we survived 2020. We survived a sell-off at the end of the year in 2018. We've had flash crashes and Brexits. I mean, we've had all sorts of crazy stuff happen in currencies and in equities. And we as traders, we come out okay. But it's like when everything is down, it's just this snowball or domino of the emotions are really crazy. And
everybody gets
enough. I can't take it anymore. And they hit a breaking point. So
everybody gets pushed to that breaking point, and they run out of patience. They run out of conviction. And I think conviction is probably one of the big things. If you don't do the work and do the research, when things go down, you don't know what's going on and you panic and you buy into the mania. And so, my 2 bits is everyone do some research, understand what you're trading, what you're investing in, what you're following, and that will help you not get caught up in all of the craziness that we see happening on a regular basis.